candid thoughts. From $13.50 down to where we're at now, sub $12 on futures, we saw something big take place. We saw yields increase by maybe perhaps 2 bushel per acre where we thought they were going to be in the United States. We've started to build that carry out back up. We've also gotten through one of the critical points down in South America, and that's planting. There is probably some type of floor in this soybean market, but in all likelihood, we are going to return to that type of market that gives us 3 to 4 chances over the course of the year rather than that 50-week opportunity back to back to back. What we saw was a bit of an anomaly, but I wouldn't have them panic at the moment. There still should be opportunities. They're probably just not going to be the opportunities that stay out there over a long period of time. Today's report, it's probably less centered on a yield change. I think the yield changes are factored in my opinion. We're going to be really looking at some usage numbers that could impact futures going forward. Sterling, what do you say to those comments as we open up? Agree, disagree, candidly, tell me what you think.
I do agree. I think things that they're going to be looking for, the idea is right now, we're guessing ending stocks for beans. The street estimate is 366, up from 320 last time. The 500 number's been kicking around. The good news is crush margins, which we only talk about briefly, are really good. They're really strong. And that could improve things like, so I've started covering meal exports. If we can do that, that will help provide a little bit of buoyancy. The problem is what's going on in South America and South American weather, and we're going to be talking about this on our third Thursday marketing meeting. The weather in South America, even though we have another La Nina, is not what it was before. It is, we are seeing good moisture coming in. In fact, enough rain to where we may even have a planting delay here and there in a few places. So with that being the case, I do think that we are, we're going to have to be nimble here. We're going to have to pay attention because we will get those opportunities, but they're going to be fleeting. And particularly if we get more and more confidence about that South American crop, we are going to see prices continue to be depressed. This doesn't mean it's going to kill the corn market, though. I think corn, due to where input costs are, we've seen good buying in corn. In fact, funds bought 77,000 contracts on the last COT report. This is something where we may see corn have to gain some favorability in here, where beans are going to be kind of floppy and you get some good news, they bounce, but they generally grind around.
So, one thing that you can take from what Sterling said, and these are one of these things that I think we're giving you some very, very sound information. Sterling talked about domestic demand, and by that, I mean crush is really going to be good. And why is it going to be good? Because margins are good. So what does that mean for most places? It means a strong basis. So if you don't come from that grain background, it's futures plus or minus basis as your cash price. Basis should be strong. Basis should be strong into the future. So as beans become a little more scarce, which is usually in your summer months, basis levels become higher. And that's not a magic wand statement. That's normally the case in most years. When you combine that with a little carry in this market, there's still some pretty good opportunities for most parts of the country to get above $12 soybeans into the future. And is there anything wrong? I just took a call from a guy who said, he doesn't have a bean sold. He hates to sell after the market's down. Is it a bad thing to lock in $12 plus soybeans if you get that opportunity with carry in the market? And when I say carry, meaning the market is higher in the deferred months when you look at March, May, and July on the futures, combined with that strong basis, there's nothing wrong with getting a start there. So that's the good news is we've got solid demand there.
Exactly. And I think that should probably continue at least until we get into January or February. When we get there, now we're talking about South American soybeans being in the market. and we could be in a bit of a different place. Livestock numbers remain pretty good. We're seeing pretty good feed demand, but I don't think the USDA is going to up this on this report in particular. And Christy, can they see my screen now?
Yes, we can see your screen.
There we go. So, you know, the beans, you kind of have a tenuous spot here. And if we don't get bullish news out of South America, it may be a little bit more difficult to get some bullish inputs into the market, which, you know, one other strategy, I'm not recommending this right now, but if you do need to sell cash beans for your cash flow, we could maybe look at some sort of, you know, call option or something for a little bit of re-ownership in the market to try and take advantage of a price bounce. The one thing with beans being down so much, we have taken, you know, a lot of that call premium out of the market.
That's right. That's right. Well, Sterling, one thing that you have nailed these WASDEs for the last 3 months, if I'm not mistaken. I'm going to try to go back and catch you on something that maybe you didn't get right. You did, but so it's a joke, by the way. But 12 months ago, you said, you know, the Chinese always cancel some soybean purchases. They always did. They didn't cancel many last year. There's some talk and I get tickled at this. There's some people that are scared that the Chinese might cancel some soybean. 90% of the time, the Chinese cancel soybean purchases. So that's not something that last year was a bit of an anomaly. And there's some concern with exports. I think we're going to see a lot of our eyes on exports over the next few months. What's the likelihood of China canceling out some of the purchases they've got on the books with the United States, given the start that South America has got?
Yes, the reason they didn't cancel so much last year was South American weather. They didn't have the beans. They had them purchased from us, so they went ahead and took the beans. Now, South American weather turns out to be normal, and they produce that bumper crop of 140 plus that they're kicking around. Yeah, we're probably looking at the potential for some soybeans getting canceled. Now, if there's a problem, South American crush keeps running well, then maybe we're moving to a little bit of a different situation. But again, right now, you know, we didn't have a lot of harvest problems at all to speak of here. I think we're close to, 90% of the beans harvested.
We're close.
For all intensive purposes, we're pretty much where we're going to be with what we see on this report. So, you know, the look to South America is going to become more important, and that's going to be something that's going to drive the market. The other thing I have, and this is coming from a more global macro situation, is the dollar index has actually been in a bit of a bull market since June. If we see something to drive the dollar higher, i.e. higher interest rates, lower interest rates across the European Union or a weaker euro currency, and that pushes the dollar up, that's something that's going to may create some headwinds here.
Yeah, it definitely has. You know, we see it over the last few months. So the bottom line is, we talked a lot about soybeans here, and we'll continue on that theme. Near term, you know, more so than even a WASDE report, we need to look at the South American forecast. The second thing we've got to look at is probably the most impactful piece to us right now. We've got a lot of knowns out there. We kind of know where our yield is. It may not be perfect, but we got an idea. We need to really watch those exports, because that's a big component of soybean usage out there. We feel pretty confident with the domestic use. So eyes on South America. And the kicker is that volatility period starts to dissipate right with the calendar. So as we go into January, February, you know, we're getting past those critical moments in South America. So if we are going to see some of those pops, like we talked about, those 3 or 4 over the course of the year, Sterling, November, December, first few days of January is where we've got to hope for those, correct?
Exactly, because once we get into January, we're going to have our picture of the soybeans from South America is going to be much clearer, and along with that, those beans are going to be entering the market. Yeah. So we do have that going on. The good news is hog prices, while they're still very depressed in China, have picked up a little bit. So with the increase of their hog herd, that may create a few opportunities around the edge. But is it enough to really move things? It might be worth 15 cents in the soybean market. So again, probably not a big item just yet.
Lots of calls, and sometimes as producers out there, as farmers have to be optimists. We know that they've got to be optimists to put all the money into an acre to try to get something out of it. I get a lot of calls, and I know I disappointed a lot of people whenever they want to talk about how inflation is going to take soybeans and corn up. Have you seen the inputs? Corn and soybeans can't stay this low. Unfortunately, the market is not concerned with the farmer's bottom line. And Sterling, you've put some really good information out there over the past few months that really does not show that long-term correlation with inflation and soybeans and corn. I know a lot of agents get those questions, and we've got a lot of agents on this call. Give them some ammo to kind of combat that inflation versus corn, inflation versus bean price.
Okay, I want you to think about when wheat went to $20 a barrel or $20 a bushel up in Minneapolis. Okay, that was basically a multiple of a factor of 4. Okay, did the price of bread go up by a factor of 4? What were we paying? $6, $7 a loaf for bread? No, we weren't. Consumer inflation is inflation that moves through the entire food chain. Yes, it can start at the base if you see wheat or soybean or corn prices move up. That can be the start of it. But you can have inflation throughout that entire rest of the supply chain. So what you're paying at the grocery store may have zero relationship to what goes on. And there's plenty of historical examples of this, Minneapolis wheat being one of the most current one. Another one to think about is when hog prices fell completely out of bed in 1999. I mean, we were down, the board was trading 15, 20 cents, some just horribly low number. Price of pork did not go down in the grocery store. By the same token, it works in reverse. So if we're looking at supply chain inflation, which means energy prices and labor prices mostly, that can stay in place. And we can see inflation at the grocery store. That does not necessarily mean that base commodity prices are going to keep up. There's no reason for that necessarily to happen.
Right before we start on here, I've got, and I know we're gonna be interrupted by these numbers. They're gonna come through any second here, so we'll postpone this conversation. But we've got a lot of cotton folks on here. I want to talk about cotton real quick before we end this call. Have we got any fresh numbers out there, Sterling?
The numbers will be out in a minute and a half. In terms of cotton,
okay, I'm a little.
Cotton's actually still holding up and looking very well. There's still plenty of story out there to keep the cotton market moving. I looked at some option prices yesterday for you, Brooks, and as I noted, volatility is gassed up, to a huge amount. Right. So there's a lot of nervousness in the market. One thing, India is a big cotton producer, and their crop is expected to be noticeably smaller. So that, again, is going to leave the U.S. as being a source. So we continue to see good news, and the market continues to be supported. High energy prices are supportive. And as long as the stock market doesn't have too much of a problem, I don't think that's going to really necessarily weigh on cotton prices. So while I've been bullish cotton for about 60 cents a pound, I'm getting a little less bullish and a little more concerned in here. And trying to hedge right now is going to be a problem. It should be a little bit easier when we get past this report, but it's something, if anyone has any questions, please feel free to call me. I'll happy to work out whatever details we need to work out. And we're going to get these numbers in about 5 seconds, hopefully. And they're out, and the corn ending stock number came in at 1493, which was pretty much in line with expectations. Soybean yields came in at 51.2. The street was looking for 51.8. That is a reduction from 51.5. The soybean ending stocks number, which is the big nervous one, a little higher at 340. We were looking for 360, and we were 320 last time. So a little bit under, but still a higher number overall. Wheat ending stocks came in at 583, which was right in line with expectations.
So, Sterling, I'm going to interrupt you real quick. Beans have taken off on that news. We're currently at, we traded 25 higher on the Jan. We're right now 20 higher. 12, well, actually, now it's a really erratic market, right around 12.10 Jan futures. So a positive reaction from soybeans.
Yeah, and remember, there's a lot of knee-jerk reaction as soon as these numbers drop. And if you look at today's Tech Tuesday, I'm going to have charts of what things looked like before, and then I'm going to do charts from the close so you can see exactly how this plays out, because very often we see an immediate spike higher or a drop lower, and then once the market has a little bit of time to digest these reports, things can normalize. Other items here, wheat yields were left unchanged. Cotton ending stocks for the U.S. came in at 3.4, which was a little bit above expectation, and the world cotton ending stocks number came in at 87, which was right in line with expectations.
Sterling, I'm going to go back to soybeans, and I hate to beat a dead horse here, but to illustrate my point earlier, right now July is trading near $12.50. So $12.50 on the board, plus that basis in most places. I know we got some folks up north that won't see a positive basis. So that's a pretty good combination right there. There is nothing wrong with a nice 60 bushel yield and 1250 plus beans. So just kind of illustrating that carry in the market that we talked about earlier.
Exactly. And, you know, 1250 is not a horrible price, but it's sure a lot better than 950. And I'm not saying we're going to 950, but if we get a big South American crop, we should probably be a little bit concerned about that. So if you want to lock up a little bit there, there's plenty of time in that, and there's always things we can do around that with some options and things to, you know, enhance a hedge like that.
Well, we certainly like days like this, especially whenever we've had some depressed market. Beans trading 34 higher, corn's up 7 to 8. And wheat continues to move up. July wheat in Chicago 780. Kansas City on the July is 782. Let me take a look at Minneapolis here. Minneapolis, it's up in tandem with the other two. Seen September at 853, and nearby trading at around 1020.
And, you know, with the Minneapolis wheat, there was a huge fund position, and we saw that fund position get liquidated.
Right.
And that is, a particular issue. When I look globally at wheat, particularly across the Eurozone, there's still plenty of demand. Those wheat futures in Paris are doing just fine. I think once we get past this hiccup we had in Minneapolis, which was the unquestioned leader, you know, I think wheat, I feel a little bit better about the wheat than I do the other two. I think the wheat does have some upside here. With corn, the corn yields actually came in at 177, which was pretty much in line with expectations and a little bit of a boost. Corn ending stocks came in at 1493, which was pretty much right in line with where the numbers were expected to be. So not a big shock here with the corn. Corn is probably getting its strength on loan from the soybeans.
So as we come out of this, we a lot of times, Sterling, we get that initial reaction like you talk about, and then a cooling down period. The bottom line is we didn't change things a tremendous amount. From where we were at 6 months ago today, we have built stocks, and we will continue to build stocks. At least that's what history suggests. With an average crop in Brazil, followed by what people believe might be a 750,000 bushel or acre increase in the United States on soybeans, we've got to be mindful that the type of market we've seen over the last 12 months is unlikely to sustain itself into the future. Times like these, we take a deep breath a lot of times and we sit back and we take that wait and see mentality when it comes to marketing, when in fact this looks like a pretty good opportunity to take a look at putting your first new crop contracts on. Would be something that you might want to consider as well. We talked about this in the third Thursday marketing meeting last time around. We said if you're going to put your dry fertilizer on in the fall, if you go north of where I'm at, and perhaps you're putting anhydrous on right now, you got to look at what percentage of inputs that represents for last year's crop. So all the time I get the call, I get the call and the question, how much should I sell for new crop? And the answer right now is because we're in this period that crop insurance, the policies don't really protect you very well at this point in time. We've got to wait until February till we get that average. My answer is if you put 20% of your total direct and indirect costs into that crop, then 20% is not a bad spot to start biting off these hedges. So when I mention that, we look at November beans for next year. This is November 22, 1234, not a bad number. December 546. Now we look at that. Will you make the money that you made this year? No. It is very, very, very unlikely to repeat last year's margins in most places of the country. They were really good. Inputs were relatively low, very low compared to where they're going to be for this year. And, we're going to rely on above average yields to really put the numbers in the black. It's tight, but that doesn't mean that we shouldn't start to take some bites there. So that's one thing that you can put out in front of your customers if they ask, is try to match up your sales next year with the percentage of inputs that you bought. Any questions on that, you can type them into the chat box. But I really, really feel that that's sound advice. And I know a lot of producers call their agent, looking for that type of information. And I think that's a sound piece of marketing advice is what we can give out right now.
Yeah, that takes into account the present situation. If you are in the winter wheat market, the prices going out are still very good. There is some upside, but I talked to a couple of producers today, and I recommended basically the same thing I did last year, small incremental sales, as there may still be some upside there, but these prices for winter wheat in particular are very, very good.
And I see we've got Sterling, before we hop off here, and I know we didn't concentrate on cotton that much, but we got Becky and Casey on here. I know they're from Texas. There's probably a few others from cotton country. So there's a lot of interest right now on, I want to lock in a floor on this cotton for next year. And you and I, we didn't really discuss it. We exchanged some emails on it early in the week. Perhaps we don't look to next year's crop on the futures market to try to protect, but do something in between. Do you want to talk about that? I know that you're not a huge fan of these options right now, but how would you approach it if somebody absolutely wanted to do something?
If you absolutely wanted to do something right now, I would look at doing a future plus the call option. That would probably be, right now, that's the most economical way. Any combination or anything that you do, it should be involving selling an option right now along with buying one, whether you do it as a three-way or if you do it as a put spread. And that's simply because the implied volatility is so high and these options are so gassed up, it's you're going to be paying a lot for this premium. And if the market doesn't fall out of bed, you may have a problem. The advantage of doing the call versus the futures, you know where you are, and you can leave a little bit of room for some upside.
We talked about perhaps, placing some hedges in some old crop months, which is not exactly hedging 101, but with these elevated inverses in the market, it's not a bad method to hedge. It just doesn't give you that protection all the way through next year. So you could look to some March, May, July type options, assuming that there's enough liquidity in them to trade.
Yeah, and again, with cotton, liquidity can definitely be an issue. It's definitely very much a front-month market, and when we start getting out too far in time, you're going to be combining two things that option sellers really like is you're combining liquidity risk, meaning it's not very liquid, so the bid offers are going to be wide. Along with it, you have very gassed up, very high implied volatilities. So that means if you're the option buyer, You know, it's very much caveat emptor, and be very careful about how you do this. And it may mean, you know, if you want to buy this option, it may mean resting an order for a few days to get filled so you get your price rather than just where the market is.
Good thoughts, good report today. Don't see any questions popping up. Christy, have you got any on your end?
I haven't had any come through.
Okay.
Feel free to
Very
put those
good.
into that chat box, though, if anybody has anything. I'm not seeing anything in the Q&A or the chat, though.
Well, that means we've either done a really good job of covering the numbers or really bad, one of the two.
I think it's pretty good.
Well, again, you know, the big surprise here is soybeans did not meet bearish expectations. We didn't get that 360, 370, 380 ending stocks number that everyone was looking for. So does this mean things could change? Absolutely, it could change. And this is going to be the last really big report. The December report typically is fairly quiet. So now we'll be looking towards January. So it's time to start thinking about next year.
Very good. Very good. Well, we'll keep an eye on these things, and we appreciate everybody tuning in. It seems like these WASDE reports are more and more eventful over the last 3 months than I've remembered them being at this time of the year. So interesting to see what numbers come out. If you guys have got any marketing questions along the way, Christy's going to throw out the email to send those to you. A lot of you have my cell phone number, and any chance you get, give me a buzz, and we'll talk marketing.
Yes, thank you guys so much. Brooks, Sterling, you guys always make this. Well, I mean, I know you guys are just reading the numbers, but wow, thank you for your insight and for, you know, just giving us what we need to know and how to use these numbers for our operations. It means a lot. If you guys have any questions, please feel free to send those to marketinginfo@sampointernational.com. That has been put in the chat. This information will be in our Tech Tuesday. If you're not receiving that, shoot us an email to that email address, marketinginfo@sompo-intl.com. We'll get you signed up today. That is an easy and quick fix. We'll be happy to get you on that list so you can start receiving that today. Make sure you get those in by noon so that you can get on that list. We do have our next third Thursday. That will be next Thursday, November 18th. We have an exciting day planned for you. It starts at 9 a.m. We have Jeffrey Dorn. Did I say his name right, Sterling?
Yes, you did.
Yay! He is with Planalytics, and he and Sterling are going to talk lots of weather in South America and some other great things that they know. And we've got Brooks and Sterling talking marketing trends, and Mike Toohill, who's going to talk a little bit about fertilizer and what's going on, you know, all across the nation, but, you know, a lot here in the Great Lakes area. So be sure to join us and, you know, share those questions with us. So we look forward to keeping in touch with you. And this has been recorded, and we will have this in an upcoming daily market outlook. So be watching for that. Thank you again for joining. Have a great day.